I created a detailed PDF that outlines the key factors to consider when entering a trade. This video is especially geared towards people just entering crypto. These are a bunch of questions that you're gonna have if you don't have them already. So in this PDF, we're going to talk about how to identify the trend, avoid emotional trading decisions, understanding the market sentiment, identifying the strength of the move. What does it mean when people talk about liquidity and volatility? Fundamental analysis, why it's important. And this has to be the number one question. What time frame do I use to enter? Well, that depends on a bunch of variables, and we go over them in not only the PDF, but also this video. In addition to that, we also pinpoint the best time frames for the different types of trades, whether it's a scalp trade, day trade, swing trade, and so on. We're going to be talking about understanding the order books, in addition to limit orders versus market orders. And of course, most importantly, risk management. Of course, none of this is financial advice. This is for entertainment purposes only. I am not a financial advisor, just a guy on the internet who knows how to trade and loves sharing my knowledge. So if you haven't done so already, please definitely smash that like button, subscribe to the channel, and get ready to take some notes. I'm in the charts all day. My goal is to make you money. I provide the information required to know exactly when to enter. I don't give this blanket statement, buy the breakout, buy the retest. Join me every single day, 3 p.m. Eastern Standard Time, to understand the who, what, where, when, and especially the why when it comes to trading. This is why the coin's dumping. Now, this PDF will be available to download on my Patreon page. In the future, there will be a charge for this PDF. However, right now, you can get it absolutely free. So make sure to check the link in the description. So as we mentioned, there's several different factors to consider when entering a trade. Now, I'm not going to read all this to you. That's the reason for you downloading the PDF. I'm just going to highlight some key areas. So what we want to do is we want to do top-down analysis. That's when you go from a higher time frame to a lower time frame. And we're going to show you examples with an actual chart in just a moment. We also have a video with market structure on the Patreon page. Now, granted, everything that I'm showing you here, I give away for free. Now, you may think, well, why am I charging for this market structure video? It is a very detailed video explaining market structure, fair value gaps, order blocks, and a whole bunch of other things that I teach on my channel. So instead of you having to sift through a whole bunch of hours getting the information, it's all in one video for you. So if you want to save time, money, energy, everything, definitely invest in yourself by getting the market structure video on Patreon. If you don't have the money, don't worry about it. Watch my previous live streams. I explain all this stuff. Not only that, but join me daily, 3 p.m. Eastern Standard Time, and ask me questions. Now, granted, I'm not going to spend 45 minutes to an hour explaining one topic, but I will give you the gist of what you need to know when it comes to whether it's market structure, indicators. My goal is to make you money. So with that being said, let's go ahead and start with the top-down analysis. What does that mean? So top-down analysis is basically going from a higher time frame to a lower time frame, just so you can see the overall or macro view if we're making higher highs and higher lows. So here we have a high, a lower high, possibly a lower high. Then if we go to the daily time frame, we can see this more in detail. We have a high, lower high, and a lower high on the daily time frame. Then we can also go to the 4-hour time frame, just to kind of zoom in and see all the price action, all the ups and downs. So in reference to the Mastering the Market Structure video, right now it is at a discount price, and I do have timestamps to help you navigate throughout the video just a little bit better. Now, in addition to this, I also have when to enter a trade. This is a free PDF, and make sure to join for free because I'm going to have plenty of information here that's very easy to find. In addition to this, of course, I do have other information here. All this stuff is for free. It's just different ways to help you with TradingView and also add security to Telegram. So I'll be having videos on Telegram, TradingView, a whole bunch of other videos. So definitely make sure to subscribe. And again, it's free. And make sure to get these PDFs that will definitely help your trading progress. Now, the reason you want to know about market structure, also top-down analysis, is so that you don't FOMO. FOMOing is the most difficult part of trading, And basically it's just due to panicking. You don't want to miss out. But if you know market structure and you know top-down analysis, this will give you a plan versus trading on emotions. Before entering a trade, we have to understand the market sentiment. Very important for you to look at the ES1 exclamation point. This basically gives you the overall sentiment of the US stock market. If this is good, then the crypto space is generally good. However, if this starts tanking, something's going on with the economy, there's a very high possibility the crypto space will do the same. Then we have the DXY. This is the Dixie. This is the US dollar index. Now, typically when this is up, the stock market along with crypto goes down. Now, I do have videos that further explain this. And to keep this video short, which it's already long, I will also post the links to those videos that explain this in greater detail. Then, of course, we have the total 3. This is the total market cap, excluding Bitcoin and Ethereum. And this just pretty much tells you the overall market. What is the overall market doing? Is it breaking levels and gaining support, which is good? Or is it going up to a resistance level and coming down? And this, again, is the overall market. It's not your coin, but the overall entirety of the crypto space, excluding Bitcoin and Ethereum. Now, the FOMC holds meetings several times a year and is responsible for making decisions that influence the overall direction of the US economy. So this is very important. Now, they do have 2 main tools to control the economy, which are the interest rates. Now, if this gets raised or lowered, it will affect the market. Also, the talk of quantitative easing or tightening also affects the market. Now, I am going to include 2 websites that I strongly recommend you going to and just checking on this. And on the websites, of course, they do have additional information. Right now, I'm on the website Forex Factory. And whenever there's a speaker from the FOMC, the most important one is the Fed chair. At the time of recording, this is Mr. Powell. And if you click right here on this folder, it gives you more information on why it's important to the traders. Next thing you want to know before entering a trade, 2 very important words, liquidity and volatility. So for liquidity, basically that refers to how easy it is to enter and exit the trade. If you buy something that has very low liquidity, you're going to have a very hard time selling it. Then you have volatility. Now, this measures all the ups and downs, as we talked about earlier. And for more clarification, let's go to a chart. So volatility refers to all the ups and downs, the swings from the swing low to a swing high. And for in this case, it can move 43% or it can move roughly around 30%. Now, if you find a coin that has very little price action, and the extent of their ups and downs are something like this, and it's really not doing anything. It's very boring coin. This is saying that there's very low liquidity and very low volatility. There's not a lot of people buying or selling, and the ups and downs are fairly tight. I strongly recommend you join me every single day, 3 p.m. Eastern Standard Time, because we go over a variety of coins. And there's some coins that I'll look at and I'll say right away, without even charting it, nope, I don't like it. And the reason I don't like it is because of X, Y, and Z. I always explain the whys. For me, it's extremely important to understand the whys. If you have money, stop messing around, do the VIP. If you don't have money, don't worry about it. I'll show you how to do this stuff for free on the videos that we have here. Then we have fundamental analysis. Some people may not think that this is very important. However, it is, because we need to know what the coin does. Do they have a good team behind it? Does it solve a problem? Or is it a meme coin? Is it AI? Is it a gaming token? What are the tokenomics? Are there going to be a bunch of coins that are going to be released which could potentially drive down the price? Is there community support? I will also be doing a deep dive video to add to this masterclass series in reference to tokenomics and fundamental analysis. Now, granted, I've done this before on my live streams. This video for the masterclass series in reference to tokenomics will be available for a fee. But once again, if you don't have the money for it, just watch my videos or join me on one of my live streams and ask me about it. And I'll show you the information. I won't dedicate a full hour to it, but I'll show you what you need to know in a short amount of time. And I mentioned this a whole bunch of times. I really do, guys. I want to get rich with you, not because of you. The reason I do have a fee for some of these videos, one, help support the channel. And two, if you want to save time instead of sifting through a whole bunch of videos, this is your answer. So understanding tokenomics will be another video that's going to be added to the masterclass series that will be available on Patreon. Now the fun part, choosing the time frames to enter. This is very confusing as well until you have the following information. And it basically comes down to what type of trade are you doing? Are you doing a scalp trade, a day trade, swing trade? Is there volatility? Is there a bunch of ups and downs? If so, let's say you want to do a day trade. So within the day, you would have to wait for a 12-hour time frame candle to close, depending on the volatility. If it's really crazy volatility, this is going to help protect you from entering a trade and it just dumping on you. This is usually when there is a very low market cap. But if there's not a lot of volatility, well, then for the day trade, you may wait for a 4-hour candle to close. Again, we go over more of this on the daily live streams. So make sure to tune in and ask your questions. And of course, have the coins you would like me to look at so I can give you more information on those coins. We briefly talked about this in reference to the type of trade. We do have scalp trade, which is fairly quick, a few minutes to a few hours. We have day trades, which is usually opened and closed within the same day. We have swing trades, which could last anywhere from several days to a few weeks. Then we have mid to long-term holds. This is for several months, usually 6 months or over. And for the long-term investments, it's usually for a year or longer. Now here's a table that kind of explains it just a little bit easier. Next, we have order books. Now I do have a video on order books that is very detailed, so I strongly recommend watching that video. Again, the links to all the recommended videos will be in the description. But one thing I do want to point out is very important that the order books can be manipulated. There are websites that have what's called a heat map, and it shows the buys and sells, which could potentially persuade you one way or another, but those orders can be canceled. It's called spoofing. And the whales, the ones that are actually manipulating the markets, they can just be tricking traders to either go long or short. Once again, I do talk about this in my videos. We have limit orders versus market orders. Market orders complete the trade very fast. Now you have to be very careful with this though, because if you are on a very low liquidity coin, not a lot of buyers and sellers, it will lead to slippage, which means that you will be paying a lot more than you're expecting. Then we have limit orders. Limit orders is when you set a specific price, whether it's a buy or sell. Now the downfall to that is that sometimes your orders may not be filled. Now in reference to exiting a trade, it is very important to understand this. There's a huge difference between small and large market cap coins, and especially in a bullish or bearish market. Here I talk about smaller market cap coins in a bullish market, also a bearish market, the potential targets to set in both markets, in addition to the stop loss, and how many targets to put. Now for a mid to large cap coin, same thing, bullish, we have the recommended targets to set. Also in the bearish market, recommended targets, and also the recommended stop loss. So here is a table that pretty much summarizes all of the information above. We have the market caps, small and mid to large. We have the amount of targets. We also have the percentage of stop loss. We have the percentage of targets recommended in a bullish market, and then also in a bearish market. This specifically applies to any kind of long-term holds you may be having. When to exit a trade by scaling out. Now this is of course provided that your stop loss has not hit. There are several different ways. We go over this on our daily live streams. If your price action fails to maintain support levels, it's a pretty good opportunity to start scaling out of your trade. You could sell 25%, 33%, whichever you like. Then when the price action drops below key moving averages, let's say you have a 9 moving average or a 21-day moving average, a 50-day moving average, a 200-day moving average. All these levels, you may want to sell a certain percentage. Now, I strongly recommend, especially for the moving averages, to have it on the daily time frame. Because if you have it on a lower time frame, let's just say a 2-hour or 4-hour, and the price action crosses underneath your 50 SMA, and you sell most of your position, then the price goes up, you're going to be out of most of your position. Now, granted, on a larger time frame, for example, the daily time frame, if the price action crosses the 50, that may be a good area to sell possibly 50% of your position. Then we also have if the price action's unable to bounce off of fair value gaps or possibly order blocks on the larger time frames. And the perfect example is the daily time frame. Now, one of the main reasons that it's so difficult to give any of this information out, let alone all of the information that I've just provided to you, is because there's so many different variables. What is your risk management? Are you a very risky trader or are you a very safe trader? Is this the only money that you have and you cannot add to your portfolio? Or will you be adding to your portfolio a few times a month? All this equates into your risk management. Now, if you want to be very successful and have a very effective risk management, then what some traders do is they have an extremely tight stop loss on every single trade. They have around a 1% stop loss. Now, the downfall to this, especially if you're an emotional trader, and in the beginning, we all tend to be emotional traders, you may get very frustrated with getting stopped out multiple times before the price action actually takes off. Strongly recommend setting alerts. That way you can be alerted when the price action crosses a level, and then you can enter your trade. Now, we're going to show this on a chart just to better explain this concept. Now, I do have the replay button on, so we can play this in very fast speed. But let's say this is our level that we're waiting for it to break. Price action's way down here. We're going to enter the trade once the candle closes, and we're going to have about a 2% stop loss with the anticipation that if we do get stopped out, not a problem. We're going to set our alert above this area, and we're going to make sure the candle closes above this line. Once the price action comes up, we get alerted. We make sure the price action closes above this line. We enter the trade with the anticipation that we may get stopped out again. And then the price may do this, and then we reset our alert, and we wait for the price action to break above. We get alerted, we enter the trade again, we get stopped out one more time. Now you may think, man, I lost 2%, I lost another 2%, I lost another 2%. We get stopped out, stopped out, stopped out. It just takes one trade to make up for all those losses. Now, with that being said, let's go ahead and look at this price action, and let's go ahead and put the play button on, and let's just see what happens. So let's go ahead and fast forward this, and let's go ahead and see what happens. Now it comes down. We're not worried about it because again, we have our alert here. We need the price action to close above here, and we're just waiting to see what happens. And finally, we do get our alert set. We do enter the trade, and as soon as we enter the trade, it comes down, bouncing off of this support. Let's see if we stay in the trade. Oh, nope, we get stopped out. Not a problem. What we do is we set our alert again, and it's going to be above this level. So we're going to set our alert, let's say about right here. Candle has to close here, and then we'll do the same thing, 1% stop loss. So now we're just waiting. We got alerted. We enter the trade. And our stop loss, let's just say it's right here, same spot, just for simplicity's sake. And do we get stopped out? Nope, price takes off. Now, granted, we did get lucky because we only got stopped out one time. There can be multiple times where we get stopped out, but when it does take off, usually it takes off fairly well. Now, granted, nothing is definite, nothing is guaranteed. It's extremely important to understand that. There is no one magic pill or one magic strategy that's 100% right all the time. You will lose. It's very important. You will lose. The difference between a losing trader and a winning trader is investing in yourself, whether it's watching videos and taking notes, getting a mentor, investing money into your education instead of learning by the market, because that costs so much more. The trader that learns from their mistakes is the one that prevails. This PDF will be available on my Patreon page and currently is free of charge. So I strongly recommend getting it so that you don't have to pay for a fee later. Make sure to join me daily, 3 p.m. Eastern Standard Time, so you can have 1 free hour of mentorship. If you've gained value from this video, definitely smash the like. Let me know in the comments additional videos to help clarify any confusion you may have when it comes to trading. I do thank you so much. We'll see you tomorrow at 3 p.m. Eastern Standard Time. Until then, let's make this money. Everything that I say is from experience. This is what's going to save you so much time, so much money, and so much effort. See what I do. See if this makes you money. But what I do is I show you all this so that you can see, oh man, I lost today, but Joe said he lost too. So it's okay. That's what I want you to realize, guys. If you like the content that I provide, make sure to smash the like button, subscribe to the channel if you're not already, and leave me a comment in the comment box. And I'll see you on the next video. And as always, let's make this money.